I'm Sung. I'm part of the Bitcoin District Initiative, and thanks everybody for coming out. We have a great conversation lined up tonight. We have two registered investment advisors, Mike Casey and Ossie De Silva. I met them both at local Bitcoin events, and I was actually surprised to meet financial advisors, especially registered financial advisors, fiduciaries, who are knowledgeable about Bitcoin. I'm not sure if you've talked to financial advisors in the past about Bitcoin, and I don't want to paint a broad brush about advisors, but asking them what should I do with my Bitcoin allocation would be, I wouldn't be surprised if they heard like, how much should I allocate to gambling, right? Because they don't know much about Bitcoin or how it fits in a portfolio. So we thought it'd be good to have this panel to talk about how Bitcoin fits in financial portfolios and how to think about risk and volatility and how it fits within the mainstream viewpoints of how they think about Bitcoin. So just one quick disclaimer that this is meant to be for informational and educational purposes only and should not be considered financial or investment advice. So please advise with your own advisors before making any investment decisions. I'll go ahead and moderate this by asking some questions, but also leaving plenty of time at the end for Q&A. To start, maybe we should do some introductions. Ossie, if you can go first, then Mike.
Hey everyone, my name is Ossie De Silva. I'm the Chief Investment Officer of Capital Squared Financial. We're a Rockville-based boutique wealth manager, financial service firm. We do focus on an older client base that focuses more on retirement planning. But before I joined Rockton, I had my own firm, Rockton Advisors, that I set up in 2020, specifically because I thought everybody should have some amount of allocation to Bitcoin. And I also then ran a private crypto fund from 2022 to the end of last year. So I've done a bunch. My own background is in global macro investing. I spent 25 years investing primarily international stocks for large pension plans, endowments. I worked for a hedge fund and then some of the global investment banks. Great to be here.
Hi, I'm Mike Casey. I'm the founder of AE Advisors, my own firm. I've been in the business since 2012 and decided to start my firm because I knew I had to be independent. In 2019, I wanted to allocate Bitcoin to client portfolios, and the only way to do it was to be completely independent. So it's been a fun ride. We're growing, and I'm really excited to be here.
All right, so the first question I want to start with is this macro thesis you hear a lot in Bitcoin circles. So I want to explain what that thesis is and get your reaction about what you think about it, and also if it's prevalent with other advisors you talk to, or if it's still considered like a sort of an outlier view, and also if you need to believe in this macro thesis in order to invest in Bitcoin. So it's going to be a little bit lengthy, but I just want to get out this thesis that you hear a lot in, lack of a better term, Bitcoin influencer circles. And so the theory is really two different parts. One is that the debt is going to keep growing because in order to pay the principal and interest, you need to create more money. And so you end up in this situation where in order to pay off high debt levels, you have to just create more debt. And so the natural outcome of that is increasing debt at the government, individual, and business levels, that it just will keep growing. And that's because our money supply, our spendable money, is largely made up out of credit. And so basically in our fiat system, if you have high debt levels, it's really hard to get out of that because you have to pay interest. So you have to keep just growing the debt. And so you always see these debt levels over time growing, right? So that's one force that's out there. On the other hand, you have a situation where there's going to be more efficiency because capitalism and technological advancements, especially in AI, will drive you to create more goods and services for less input. So basically, you get more efficient overall. If you had a stable monetary system, that would result in lower prices. And so now you have these two competing forces, an existing monetary system that cannot survive without some form of inflation or increased money supply. And then you have a force that's usually technology and capitalism that's going to drive prices down because you can create more goods and services with less inputs. And so, for example, if you need at least 2% inflation to keep the system going, and deflation is 5% because of technological increases like AI, you need to create 7% more money to make it payable. And so those are the long-term processes that are there. And if you believe in that, then there's another effect called the Cantillon effect, where if you have more money supply created, and people closest to that will benefit. So therefore, asset holders will benefit more than wage holders. And so if you make your money through holding assets, you'll be better off in this process than if you work for a wage, right? So you hear this a lot when you listen to like Bitcoin podcasters or people who write books in this space. But my question to you is, how prevalent is that with other financial advisors? Is that going mainstream, or is that just some type of outlier type of thesis?
Mike, why don't you take that? You've been in this
Okay.
area for longer than me.
Yeah, so I love that question. There's a lot to unpack there, but most advisors don't think that way. They're not looking at monetary economics. I can tell you, part of my Bitcoin journey, I've had to learn monetary economics in order to really do a deep dive on Bitcoin. So you mentioned the Cantillon effect, where the people closer to the money printing benefit because they get to spend it first. They get to spend it before it inflates in value. I mean, basically everything you said, I agree with. It's factual. I think most advisors, and just like most people, aren't aware. They just don't know. The paper money, every single fiat currency has failed. I'm a patriotic American. I love the country. I don't want to see the dollar fail, but the dollar is a fiat currency, and every fiat currency has failed. So maybe it's time to move to something better.
Just the second part of your question, in terms of what advisors think or say, I have this deep background of living, working, investing in kind of emerging markets, international, so it was natural for me to get drawn to something that's scarce and will hold value. But I would point to Bitwise, which is one of the ETF providers, along with Vetify, which is a advisor-focused news service, has a survey they put out every year. The 2025 one came out this year, the last few months, and it's about advisors allocating client money, and there's been a nice steady increase, and I think it's at about 30% now of that sample, several hundred, I think. But interestingly, when you ask the advisor, how many of you own Bitcoin, the answer is something like 65%. So I think just like people price effect, right, goes up, it has the same effect on advisors, whether they have a deep understanding of global macro or not. And I think a big driver is they have heard from their client base for years now, hey, I want to allocate to Bitcoin, and the answer has been no. Now there's an ETF, so I think they've had to learn as well. So there is that growing understanding, and clearly adoption by the advisors going ahead of the understanding.
Yeah, so I would think that macro thesis that I was talking about is related to, lack of a better term, of Bitcoin being digital gold, and so you can preserve your purchasing power because there's a natural increase in the monetary supply, right? But just to follow on to the next question then, is how you think about Bitcoin, like for example, being digital gold, some asymmetric technology play, a monetary hedge, or something else impact how you allocate to it?
So I think Bitcoin, looking at it as digital gold is a good exercise. I think ultimately Bitcoin is better than gold. Because gold still doesn't have a fixed supply, right? It can't be printed, has to be mined. But the supply of gold increases every year as 3% of it gets mined, from the seafloor, from under mountains, from wherever. And Bitcoin having that hard stop, ultimately, there's just so many benefits. Like, I don't know if we want to get into comparing Bitcoin to gold, but there's a lot of benefits that Bitcoin has that gold doesn't have. I think it's ultimately a superior asset.
Yep, I guess I would agree with most of that. It's a monetary asset, meaning all of us has given the value, right? There's not the intrinsic value, just like gold. I look at gold and Bitcoin as kind of two different players in the same team. Like in the last 12 months, gold has done much better, Bitcoin hasn't, but then over the last 10, 15 years, Bitcoin's done much better. I do think as Bitcoin as an asset gets bigger, both the volatility and the upside, upside and downside will come off. So I look at it both, like I said, same team, different players. I would, to your original question, it's digital gold, but you could also look at it like a venture investment where there's tremendous upside. It's blended into what Bitcoin is. It is, unlike gold, a new technology, and so there's got that adoption-led future.
Well, it does seem like the digital gold narrative is getting more entrenched in the space, but in the past, maybe there's other coins out there that have looked into this about being more of a technology play because it can create some utility in the future. So I was really asking about, are there other if you viewed it differently, more like a technology play versus a monetary hedge or digital gold, how does that impact your investing advice?
I mean, I look at it, like I said, it probably has attributes of both, but I take my client base is, I would say, Bitcoin novices. And I think what drives my allocation decisions are much more about, it's all individual, but can this person stomach the volatility? And it obviously needs to go into a growth portfolio where you can take a, say a 3 to 5 year view. So that, I'll just stop there, but that's kind of my main, and just to answer it, gold may have similar characteristics, much less volatile, so maybe I consider it in a larger size.
So I see Bitcoin and gold as generally very low risk, right? Low risk pieces of a portfolio. Neither one of them can go out of business. Neither one of them, they've never had a bad earnings report, anything like that. Both of them can fluctuate in value. Gold is still somewhat volatile, although not nearly as much as Bitcoin. But they're both safe. They're neutral, right? So no one person controls gold or Bitcoin. No company, no country. So I see it as it's a neutral asset, and to me that gives it more value than something that is easier to impair, that can be shut down.
Okay, so you're saying that you view it as more of a long-term, low risk long-term, but the price can be pretty volatile in the short term. But there's less other types of risks out there that a company might have, like management and operational risk that these other assets may not have. Right. Also, this is more of in the context of adoption by portfolio allocators. So can you explain how correlation, volatility, and returns, including things like the Sharpe ratio, impact how allocators are willing to invest in Bitcoin?
Yeah, I love this. So Bitwise has a chart. Grayscale does too, but I think the Bitwise chart is a little bit better. And it shows a 60-40 portfolio, your standard moderate risk allocation. And then it shows a couple different allocations of Bitcoin. And what I love is the 5% allocation to Bitcoin over a 10-year period, you double the return of the 60-40 portfolio with just a 5% allocation to Bitcoin. I think you get like an additional, your maximum drawdown is like maybe a point and a half, maybe even less than that. So for just a slightly higher drawdown, you double the performance of the portfolio. It's a no-brainer. I show that chart to every client that I can. I let the facts and the data tell the story. You know, I'm just the person giving the message. The facts and the data, the historic numbers speak for themselves.
I'm going to run with that. So I also happen to use the Bitwise. There's an allocation tool. You do need to sign up to use that. If anyone's interested, I actually have a couple of charts where I've added, 1, 2, and 5% into your portfolio, and it shows you how much better it's done. And to your question about the Sharpe ratio, where the institutional world looks at not just the better return, but return relative to the volatility, the ups and downs. And to Mike's point, you've got substantially greater return by having, say, a 2% or a 5% allocation, obviously more return for a 5% allocation versus 2, but the increase in portfolio volatility is not much, maybe 1%, maybe 1.5%. And that's because of the other question about correlation, where Bitcoin's correlation, even today, to traditional assets like the S&P 500 and the NASDAQ is low. It was much lower and points negative in the 2015 period. With the ETFs, it's increased, but if you look at, for example, the last 3 months, the correlation's still around 50%. So not super low, but it's still low enough where you can add, and it's not going to increase the entire portfolio volatility. So I would encourage, if anyone's considering adding Bitcoin or how Bitcoin would have increased or worsened your portfolio over the last 2, 3, 5, 10 years, the Bitwise allocation tool is a great spot.
Yeah, I always thought that a way of thinking about portfolios is useful, because one thing you hear a lot about something like, say, Bitcoin or even some other investments that are highly volatile, you might say, hey, it's too risky because it's volatile, and just, hey, it's just risky, I don't like it. But if your returns more than compensate you for the volatility you're taking, and it's not correlated, then it's going to be valuable, right? Because if it's highly correlated to what you already own, then there's no reason to add it to your portfolio. But if it's not correlated and you have a high return versus volatility ratio, then it is valuable to add that asset to your portfolio. And so the more that you would see Bitcoin be less correlated to other things like gold and stocks, should actually get other investors interested in adding it to their portfolios. If it's highly correlated to, just say, tech stocks, then it may not be that valuable to add it to your portfolio. So I've been always watching, like, well, how correlated is Bitcoin to other things?
One thing I would add is, now that there are a bulk of the capital coming into Bitcoin is coming through the ETFs, since they were launched in January 2024, in short periods, and my short period could be 12 to 24 months, I would expect, and we've seen this empirically, the correlation go up. But I guess the question is, given the unique nature of this asset, I would still assert that the 5-year correlations probably continue to be fairly low, especially given what's happening with the debt levels globally. So that's an opinion, I guess.
So how does your age impact your allocation, and what percentages should people be looking at?
Yeah, so it's really just about the risk tolerance, and generally, when grandmas and grandpas buy Bitcoin, we generally keep it to a lower allocation, but that's not always the case. I've met some people that a little bit older, retired investors, and they came from the gold world. They were sound money advocates. They were already done with fiat currency before Bitcoin came around. And so once they learn about Bitcoin, they realize, hey, this is even better. And so they want to take a larger position in their portfolio. At the same time, you could have a younger person that generally we're going to allocate a little bit stronger into Bitcoin. But what I've learned is people are very emotional about their money, and you can't put them in too much volatility. If it's not comfortable for them, then they're not going to feel good about it. So obviously, I want to try to get as much allocation to Bitcoin as I can into someone's portfolio, because I think we're doing a lot of good for the person. But I want to do it in a way that's responsible. I want to do it in a way that they can sleep well at night. And if they're thinking about changes in value, I might want to dial it back a little bit until they can learn more about it and understand that it's a different asset.
I guess I look at, for all of our clients, I would say the bulk of the clients are 45 and over. I would say there is a kind of a stable portfolio that I look at, and if you're 45, you're 20 years away, maybe you need minimal stable portfolio. But it depends for every client. I think advisors love to say the answer is it depends. With that caveat, even if you're 75 or 80, and you have the ability to take on a growth portfolio, I think there I'd be happy to allocate just as I would for a 45-year-old. So it kind of depends. If you're, don't have a lot of assets and you need much of it to be stable so you can consume, even if a market sell-off comes over the next 2 or 3 years, that gives you less flexibility. But for somebody who's well into retirement but has a decent pot to consume off of, say, for the next 3 or 4 years, I would have the ability to allocate more aggressively in the growth portfolio. But again, to Mike's point, you want to get people comfortable with this asset. And I have one of my older clients, after several years now, they went off and bought Bitcoin, and they're like, I want to move it to my own wallet, right? That's kind of the pathway if it's boosts your returns and your comfort level as well.
Well, so how do you prepare your clients for 50 to 80% downturns? I'm not a professional advisor, but I had friends who would say hey, I would like to invest some in Bitcoin, and one of my first questions would always be well, how long are you willing to hold it? And they'll say long term, okay, sure. If you're willing to hold it 5, 10 years or until you're retired, then maybe you should invest some in Bitcoin if you believe in these things, right? And then, since October, it drops 50%. They're like, I'm out. And I'm like, well, I thought you said you're going to hold this at least 5 to 10 years. Yeah, no, I'm just out. I'm like, okay, well, clearly they don't know their own risk tolerances. But it's one thing to say that you're willing to take some risk for better returns, and there's another to actually live it, right? So how do you actually work with your clients in those situations?
Yeah, that's a great question. A lot of there's an art and a science to the business, and I think some of the art is getting the allocation right. It has to be something that the client can live with, and a lot of people won't really admit right away if they're super risk averse. Some will just tell you, hey, if I lose $100, you're going to get a call at 6 a.m. the next morning, right? Obviously, they're going to have a different allocation. So, we want to do it in a way that's responsible, that the client feels good. Even if Bitcoin does drop, it's never gone to zero. It's the most asymmetric asset. So I've had clients where we'll talk about Bitcoin. They won't take a position right away, but they'll circle back with me, maybe a year later, sometimes a little longer, and they'll say, hey, Mike, I remember you talked about Bitcoin. We've looked into it. We've studied it a little. I think we're ready to take the plunge and invest some. And I always prefer that because now they've done some research. They're kind of primed. They're warmed up. and they know that a little bit of volatility is not gonna hurt them. Overall, the risk-adjusted return of the portfolio, they're going to benefit, and for a long-term asset, it just makes the entire portfolio perform better.
I would say my data points, my clients are self-selecting because my conversation and what I write about is that my global viewpoint and the way I asset allocate is not your typical 60-40 portfolio. It's made up of a lot of stuff, including Bitcoin, so I lead with that. So I think those who come to me come with some comfort. Having said that, what Mike said, people will say, oh yeah, I'm really risk-seeking. I'm happy to take high risks. That's often not the case. When the risk happens, people run to your friend's decision, right? So I try to position size. So even if I think a person could maybe have a 5+% allocation, I would probably, if I don't know them well, and Bitcoin's at a peak, say 120,000, I would probably position size pretty conservatively. And that's worked out well because in the 2021, 22, the clients didn't even feel it because the position sizes were fortunately small. And they were then happy to buy more when the prices got down, below 30,000.
So both of you, I believe, had clients in Bitcoin well before the ETFs showed up in early 2024. So how's that changed now that ETFs are out there? How do you determine if a client should self-custody, get exposure to Bitcoin in other ways, or just buy the ETFs?
Yeah, so I tell clients, you can self-custody. If they want to do that, I'll walk them through it. I'll help them set it up. We can hold the coins at a digital custodian, like BitGo, or we can, buy the spot ETFs. I think for most people, they don't look at Bitcoin as a monetary protocol. They look at it as another stock, right? They're buying shares of a fund, and so in that sense, allocating to the spot ETFs is very easy. It's frictionless. So, and I think the spot ETFs have done a lot to make access to Bitcoin much easier. But I do tell clients, if you want the full experience, if you want the true economic empowerment, you got to own the coins. So everyone's not there yet, and I think if you own shares of a spot ETF, you're still participating in the asset. You're still going to get the upside. It's definitely not a bad thing, and I definitely promote it.
I'm entirely today. When I started off, there was no ETF, so it was hard. It was a lot of work to allocate client accounts to Bitcoin. Now it's 100% ETFs. I have a handful of clients who have come to me and said, hey, I've read more about it. I want to have kind of my control of I want to be the bank. I control it, and not me or the ETF provider. And I'm happy to give them guidance. But I think the ETFs cover, this is my opinion, 99.8% of the potential outcomes. There is that 0.2%, or somebody might think it's less, some more, where you want to have custody of your own Bitcoin. But doing so just transforms the risk from, the exchanges going down or the custodian DTCC going down to you forgetting the keys or the house burning down with all the stuff, right? So I try to educate them about the trade-offs in terms of controlling your own keys.
So you mentioned that some of your clients were already buying off on the monetary asset theories because they were gold bugs in the past, before Bitcoin was even invented. So does gold compete with Bitcoin? Does it make sense for some people to own both? Like, how do you think about gold and Bitcoin?
I think gold does not compete with Bitcoin, in my opinion. There's some similarities. They're both neutral assets, but Bitcoin has so much asymmetric upside in front of it. It's, you know, I see it as the most asymmetric asset that you can get into. It's never really been a competition with gold. In the short run, obviously gold has outperformed. So I see gold as a nice diversification piece of a portfolio, but it doesn't replace Bitcoin.
I mean, as I said at the beginning, I think two players on the same team, it's fine to have both. And over the long term, I firmly believe that Bitcoin will take share from gold. Like gold's got, is it like 35, $40 billion now? Sorry, $1 trillion of, that's the market cap of gold, right? Bitcoin's at 1.25 or something like that. And that's going to be one of the areas that Bitcoin can grow into.
So just based on market size alone, just gold's much bigger, so possibly more upside with Bitcoin is one way to think about it. So in 2025, there was a theme going on that because of the changes in the regulatory structure, that soon you'll see like pension funds, endowments, treasury companies, just companies in general wanting to save in Bitcoin are coming. And so therefore you should rush in before the tidal wave comes. But now that we're in early 26, Bitcoin's fallen in half in dollar terms since October. Is that trend still there, or is it slowed down? I mean, what are you seeing?
Yeah, so it's still there. Pension funds, endowments, major institutional investors are still accumulating. Maybe not as intense as it was in 2025, but they're still buying. And really anyone that's buying assets for a long term, you know, like a university endowment, they're buying assets for 100 years, you know, or a pension fund. They don't really care about 6 months or 2 or 3 years out. They're looking at 5, 10 years plus, so, and I think that will increase just as the asset moves along. We're going to obviously see some changes in price coming, as things move along with the economy. So,
I think we know, right? The ETFs have been a big reason, or has brought in a lot of institutional investors. There are a bunch of pension plans. Wisconsin owns it, and the first one was like Houston firefighters, maybe.
Fire,
yeah, Houston Fire, and this is, I think, before the ETF, maybe. The Abu Dhabi Wealth Management, the sovereign wealth fund, Mubadala, owns it. We only know what's happening through the ETFs when they release the quarterly 13Fs. I haven't seen the latest one, but what I would say is even with the price of Bitcoin coming down 50% this year, I heard the head of IBIT, or BlackRock's ETF, the crypto ETF side, he was saying they've seen net inflows. And I think one of the things you will see as more institutions and people like ourselves start allocating, I'm betting that you'll see less volatility, because the way it works, particularly on our side, is, hey, if you have a target of, say, a 5% allocation to a client account, when Bitcoin goes from 70,000 to 120,000, you're likely to trim, right? It will probably have different strategies, but you will still trim. Likewise, when it falls, 5% becomes 3.5, you're going to look to add. So that should really change or compress the volatility. 10 years ago, Bitcoin had a volatility of about 90 to 100%. This is an annualized volatility. In layman's terms, that means you should expect Bitcoin to go up or down 100%, 90 to 100% every year. And it did, right? Many years it'll go up hundreds of percent, fall 85%. And now, in the last year, say, it's at 45-ish%. And so I would, think that it compresses down to a lower level in the coming years because of the institutions coming in.
Well, one entity that's buying a lot of Bitcoin is Strategy out there in Tyson's corner of Virginia. I also found it interesting that Fairfax County Police and Fire Pension, I think, was one of the earliest investors in Bitcoin, even before the ETFs came out, so they're also local. But in terms of strategy, I do see a lot out there on social media about their different instruments. And I did have a discussion with somebody at a Bitcoin event that they said they thought they should invest their short-term money in the Stretch, which is one of their preferred stocks that pays a high dividend. The medium-term investment in Bitcoin, and their long-term investment in strategy Common, because that's a levered Bitcoin play. What do you think of that allocation, just from a portfolio allocation perspective and risk? What do you think of that?
I mean, I like Stretch. I think it does a lot of good. Getting that monthly yield is a nice offset to the volatility. It also gives you some portfolio income that you can either reinvest or invest in other holdings. Obviously, Bitcoin, MSTR, so their common stock, yes, is a levered play basically on Bitcoin, so it's more volatile. When it goes up, it's going to go up more than Bitcoin. When it drops, it's going to drop. You're going to lose more. So I understand that portfolio. I don't know if I would do that. I don't do it that way myself, but I do understand why someone would want to do that. I think it's an interesting take. I would say for long term, the simplest thing to do is just buy Bitcoin. Buy Bitcoin and hold it. That's gonna be the single best thing that I think anyone can do.
So STRC, that's the ticker. You can pull it up. You know, it is now yielding something like, it's a preferred stock, 11.5%. That is equity-like returns. So to me, it should go in the equity bucket and not in, oh, this is my safe yield that I need to have to consume over the next 12 months. I think you're just layering on Bitcoin risk, because we know strategy doesn't have actual cash flows, right? These are, the cash they're paying out is funded by new issuances of stock and this STRC instrument. So when things are going well, it is awesome. No one's going to worry about it. It's going to trade at 100, which is the par value. When things go bad, it's not being stress tested. And you don't, if it's in that safe short-term bucket, I don't know if I want to have, if I'm already allocated to Bitcoin, to your point, Mike, no need to lever up. Like, that's the leverage or the debt part of a levered equity, which is MicroStrategy. So I like it as if somebody says, oh, I want I'll put it into my equity bucket, fine, but not necessarily the safe yield bucket.
Okay, so that makes sense. So you're saying, your perspective is that, let's say a client needs an X amount of dollars that represents 10% of their portfolio, which they need over the next year. And so that's your safe, low volatility bucket. But then they have another 60% in, let's say, an equity bucket, and 30% in the Bitcoin long-term bucket. You'd view Stretch as a potential replacement as your equity bucket, not taking away from your short-term, safer bucket, because there could be under stress scenarios that it doesn't keep its peg to 100. And so therefore, if you needed that money, you may not actually get all of what you're expecting. So view it more as because it's already a high return. Yeah. View it more like an equity-like return, put it in your equity bucket.
When we model equity returns, over the last 100 years, U.S. S&P 500 has returned 8.5%, 9%. You're getting 11% here. We run what's called a kind of a fortress financial plan, where depending on the client risk profile, we'll have, these are retired people or approaching retirement, right? This is not for you all in the audience, much younger. Where depending on the person, we'll keep 2, 3, 4 years sometimes or more in, safe assets. Yeah, they're on a 20-year view melting ice cubes, but if you need the money over the next 3 years, you have it. So that's kind of my mindset in terms of building really secure, reliable cash flows.
Yeah, I also personally struggle with a question for the very long-term part of a portfolio is strategy common stock going to outperform Bitcoin or not? Because there's just so many variables. Let's assume the management's great. Operationally, they don't have is going to be fine, so you don't have the management or operational risk associated with it. And it's really just a levered play on Bitcoin, and Bitcoin, your thesis on it is it's a good long-term investment. Then being a levered play, you would think that the appreciation of Bitcoin in dollar terms would exceed its cost of capital, basically the preferred share of like 11%. So if your appreciation is higher than that, that should accrue to the common shareholders. But there's another element that, which confuses me on how to analyze this, is that part of the reason they can buy so much Bitcoin is they're also issuing more common stock. So because they're diluting the common stock, you have to have so much excess return that you're not just paying off your preferred shareholders, their dividends in perpetuity, because a lot of these are perpetual, they're out there forever. You also have to offset the dilution you're creating by issuing common. So it's just really hard for me to analyze if it will exceed Bitcoin over the long term or not. The diehard true believers will say, of course. The others would say, even if you take off like management and operational risk, it's hard to know because of those different factors. And so like a safer asset could just be Bitcoin. But of course, with riskier, safer assets generally have less long-term returns, you know, if it works out, right? So that, I'm not sure how, I mean, you already answered, Mike, that you think maybe just holding Bitcoin for that part of the portfolio makes sense. But what have your other clients talk about in terms of when they ask you, should I invest in strategy common versus Bitcoin for that bucket?
I don't get asked that question.
You don't get asked?
I mean, yeah, no, right? That's why I'm there to do that selection.
Got it. I got it.
You might have some clients, Mike, I don't know.
Yeah, I see MicroStrategy as a satellite position, not a core position.
Okay.
I love the company. I've met their Bitcoin team. They're a sponsor of our local Financial Planning Association chapters. Yeah, they're doing great things, but it's a high volatility play in a portfolio. So I wouldn't make it what's called a core holding. I would make it a satellite holding, you know, a smaller allocation.
Okay. I think with anything levered in any other industry, when the industry, the cyclically is going up, in this case the Bitcoin price, you would expect the NAV premium to NAV rise and they'll outperform, but then possibly give it back. And that's kind of what we've seen, right, over the last 24 months. Sort of massive premium. And it's kind of trading close to NAV maybe now. And they did, to your point about dilution, they have a shelf registration, right? $44 billion. I think their market cap now is close to 50, and they have a shelf registration that allows them to issue $44 billion of new stock. Will they do it? I don't know. Or will they do it in a value accretive manner? Again, question mark, but that's clearly the strategy.
Yeah, the whole NAV question gets interesting because if you have a high premium of the common share price to its underlying Bitcoin value, adjusting for the preferred and debt out there, that's exactly the time you would think strategy would want to issue more common shares, because then they can buy more Bitcoin than how much they've diluted. So when you have the MNAV expansion, is actually probably arguably the best time for them to buy more Bitcoin by diluting the shareholder, which compresses the NAV. And so the original shareholders are like, well, some of that return is not coming to me because you're just trying to buy more Bitcoin. But it might work out in the long term if they're just the company that has the most Bitcoin. And then, well, what do you do with it if you own the pristine collateral? Maybe you don't have to do anything. You can still issue shares infinitely, pretty much. So I sort of I sort of see that argument on both sides, but it's just very hard to analyze. So that's one of the reasons I wanted to bring it up. Well, before I open it up to audience questions, is there anything else you want to mention about Bitcoin or portfolio allocations?
No, I mean, if you haven't looked at what a 1, 2, 5, 10% allocation would have done to your portfolio over the last 5 years, 7 years, even 3 years, you should go look at it, because it's eye-opening what an allocation does not mean it's going to happen in the future, as we like to say, right? The past is not indicative of what happens in the future, but it has been a very powerful, the term is alpha creation, right? Value creation to retirement portfolios or any investment portfolio.
I would echo what AC said. If you're newer to Bitcoin, start with a smaller allocation. You can use the online calculators. There's a ton of information available. Obviously, if you've been in Bitcoin for any length of time, more substantial length of time, then you've seen massive appreciation along with some downside. But it's becoming a mainstream asset, and it has a fixed supply. There's only 21 million coins, so I would say get as much as you can while it's still under $1 million.
All right, so do we have any, not sure who has the mic for questions. Yeah. There's somebody in the back. Oh, right there.
Hello, Jason from the New York chapter of PubKey. Happy to be here. You guys are great. Thank you. So my question is from the perspective of, if you're interested in Bitcoin's price going up over time, and you have more of the base coming from institutional ETF, people that work with registered investment advisors, what I'm curious for your guys' business is, I would expect over time to see more people coming in, more people starting with a smaller allocation, going through a drawdown, seeing more conviction, maybe allocating a little bit more over time. Maybe it's like hiring more people because there are more people coming in, people getting more comfortable with the idea, people seeing the slow accumulation of the holder base at their specifically registered investment advisor clients. So I'm curious, to the extent that you can, and you've described part of it earlier, is how you're seeing your businesses evolve, your clients evolve, how much it tracks to, it's growing slowly, this is cool, and what are the kind of green flags that you're seeing over the past couple of years in your client base, this is strong, and then maybe if you want to say it or just get a beer later about some of the things that maybe are oh, this is something I'm keeping an eye on because, kind of thing. So I had lots of things that I could say, but I kind of just went with the whole shotgun general, whatever you want to say. Curious about how you see the registered investment advisor business base growing over time. Thank you.
I mean, I gave the stat of the Bitwise Verify survey, so I think that's a better thing than my own little observation of the DC, my handful of connections, I guess, is what I would say. I have seen firsthand, I started allocating to Bitcoin for clients in 2021, the powerful kind of, hey, I'm comfortable, maybe, let's increase it from 1% to 3% or something like that, right? So that, I have seen that firsthand, but, I speak to a lot of folks who, the investment teams that may see within the RIA community who want to allocate, but the boss or the founder hates it because it's seen as rat poison or whatever. So there is a lot of arguably pent-up demand, right? I mean, Merrill Lynch just approved ETF allocations in January this year, and even there it doesn't seem very proactive. So those are my kind of observations.
Yeah, I could just say, as an RIA, when we used to introduce Bitcoin to clients, their eyes would get big. Some people would have a physical reaction, like this is something weird. Now that's not the case. Everyone's heard of it. It's a household term. Most people haven't adopted yet, which means there's a huge opportunity to get in. But there's a lot more comfort level with the asset class, and that's really cool because I've been in it for a long time. I think it's a mainstream asset, but apparently it's not quite yet. So
Yeah, I always found it interesting that if you just listen to Bloomberg or CNBC, they actually mention Bitcoin's price along with S&P 500 and NASDAQ. Like in the past, you would never expect that. So it's, I think, widely known that it's out there and what the price is, but there's still a lot of misunderstanding of what it is. And you're right, maybe there's not as much allocation to it as you would think, but it is visible. It's not like this invisible thing, and it's mentioned a lot in the financial press and services. So I think we had another question over there.
Yeah, thank you. This was very, very interesting, very insightful. I have a question. You guys talked about gold, and I wanted to ask a question about the other thing that is on the scale there, specifically real estate. Of course, you cannot live inside Bitcoin. We all know that. But real estate, especially in this country, is a highly financialized asset, and is often used more similar to almost like an ATM. It's collateral against, you use it as collateral. And honestly, I feel like Bitcoin is much better collateral if you think about it. It's more liquid. It has some properties that make it superior. So I'm curious if you guys thought about that. It might still be quite early, but yeah, do you guys have any thoughts?
Yeah, so there's a much higher supply of real estate than there is Bitcoin. So I see Bitcoin as it's a much better asset long-term than real estate. Real estate's good. I'm not anti-real estate. The only thing is you have things like maintenance, you have property taxes. How can real estate be impaired? It's much easier to impair a real estate asset than it is Bitcoin. And the least impairable assets hold their value more, and they rise in value more. And so that really just makes the case, I think.
Yeah, I mean, for us, diversified real estate is a steady yield provider and something that should keep up with inflation, but it's not going to give you kind of the outsized return potential that Bitcoin provides. So it's certainly not in the same bucket in my thinking at all. That it's two different things. And fundamentally, Bitcoin, gold, you mentioned, they're monetary assets, right? The utility is probably not what the unit price is today. Whereas in real estate, it's driven, yes, it's financialized, but there is a ultimate utility behind it. So I look at it very differently. It can be, and it sometimes is, a part of the yield generation portfolio for our clients.
Yeah, personally, at least the people I know in real estate, if you split it up into two different sectors. There's commercial real estate, there's residential. And in the past, I would think residential is a lot closer to commercial, meaning that if you can borrow relatively cheaply and that you can make more income on your rents and maintenance, and that exceeds your costs, with your low interest rates, then yeah, that's great. It's a yield generating thing. You can lever it up, put down relatively low percentage. Real estate's one of those few assets where if you put down 20%, which is 5 times leverage, that's considered safe, right? You wouldn't normally think of that in other types of investment, but in real estate you can do that. And then you got other things like 1031 exchanges. You can play all these tax games. So when interest rates are low, and you can play the arbitrage there, where you could make high income with putting relatively little money down, that's great. But I also think now today, one of the issues is that residential rents relative to the real estate price is so low and interest rates are higher, that may not work out as well nowadays. And so that may not be as good as a long-term investment. But in the past, it makes sense with if you're able to borrow cheaply, why real estate was such a popular vehicle for generating income and also having some appreciation, inflation hedging going on as well. But it would not have necessarily the outsized returns. If you see outsized returns in real estate in the past, it was largely because you can lever it up. And with Bitcoin, you don't necessarily need to lever that up to get outside returns if you believe in that thesis. So, I think we only got a couple more minutes left. Did you have one more question?
Just a comment and a question. So I'm a Bitcoiner, and I believe in self-custody. But when the ETFs came out, I called the company that manages our 401k, So I'm not talking about your IRA, but the money that's trapped in your job's 401k. And I said, can I invest in the ETF? They said, no. I said, is there a way I can self-direct into a brokerage? They said, yes. And so a lot of people don't know that. You can actually use funds and buy the ETF. And so I bought Fidelity's FBTC because I don't trust Coinbase, because I know Coinbase custodies for a lot, BlackRock and a lot of the other ones. So my question is, 20 years from now when I retire, is there, like, I think it's called in-kind redemption, is there going to be a way that this paper Bitcoin can actually be turned or transferred to me as actual Bitcoin rather than selling for dollars?
That's a great question, and I love the fact that you did that you looked into it. So, you know, I'm the plan advisor to some 401ks, and I tell the plan participants, if you want to get into, I recommend that you take a position in Bitcoin, and if you want to do it, here's how. And we walk them through setting up the brokerage window. And so the fact that you looked into it, that you did that, that's awesome. That's I wish more people would do that. So in-kind redemptions in a qualified plan, that's a really good question. I know a lot of spot ETFs right now are starting to offer in-kind redemptions where you can, so for everyone here, that's so you can redeem your shares for sats, for Satoshis. I don't know exactly what that's going to look like in a qualified plan because you have the tax.
Well, I think
has to be
I'm
figured.
not sure if.
So the in-kind redemption for the ETFs is not for you and I. It's for the large market makers. So it's highly unlikely that individuals will have in-kind redemption. And it's part of the market structure, but certainly hasn't been the case. ETFs have been around for decades now. There is no in-kind redemption. There is, you would hear the word in-kind redemption. That is how.
It's the authorized participants, right? They're allowed.
Yes, it's for the participants who make markets, and that's what allows the ETF wrapper to be more tax efficient than a mutual fund.
But these are in 401ks, right? You're saying so. Why would you need to do that if you could roll it over into an IRA, just sell the ETFs, and you can actually get like a IRA that allows you to buy spot Bitcoin, and you can do that all within the tax wrapper, so you don't have a taxable event.
Right, I was thinking rollover, right.
Yeah.
Just doing a rollover.
Yeah.
Would
Trying to
probably-
avoid a
probably
taxable
be
event, though.
The simplest way.
Well, yeah, you have
do
to make
that.
sure you don't touch the money, and you can do a rollover. I'm not a tax professional, so
Yeah.
it's just based on my own reading. You can roll it over into an IRA, and then there are certain companies out there that will allow you to buy spot Bitcoin. They can custody it for you in the IRA wrapper, so even there won't be any taxes just because of doing that until you withdraw it, or if it's a Roth, then even better, you know.
But his question was about self-custody, so I haven't looked into this.
Oh,
but-
I'm sorry. I thought you
Yeah.
were talking about.
No, he was talking about rolling it over in kind into self-custody,
okay,
right?
okay.
Yeah, maybe that there is somebody who rolls that out in, as you said, in decades
20
away.
years or whenever you need
Yeah,
it,
because
yeah.
at the moment you would roll it over and it'll stay in somebody else's custody, which is probably going to be custodied at Coinbase anyway. So
I mean, there is a drag on the ETFs, though. Like, there is a fee. And so even though it might look small, compounded over 20, 30 years, that fee actually could be a lot, because that fee is not 0.25% in dollar terms. It's in Bitcoin terms. And if Bitcoin appreciates a lot, that fee actually could be a lot especially over decades. So from a cost perspective, there is a drag on owning ETFs versus spot. Oh, Jim?
Hey, how you doing? I have a question. As markets keep pushing towards like tokenizing other assets, do you think that's going to change like how we look at portfolios with Bitcoin in the future, as far as like the stock market being tokenized 24/7, and how that would affect volatility? Would it match up more towards Bitcoin, where it may be like allow for more exposure to be more accepted?
I see I think just because you wrap it or tokenize it wouldn't necessarily change the volatility or anything like that. So I think they're two different aspects. So whether you buy the S&P 500 as it is today or whether you buy it on a token form, I don't think really changes the allocation decision, certainly not from us, and probably shouldn't for anyone else either. It's probably good for blockchains generally, but I'm still thinking we're talking a decade out for it to become efficient, because at the moment there's actually even more friction the way the current setup is with Robinhood, for example. There's there's no liquidity. How do you trade something over the weekend? Just because the market is the traditional market and it's closed. So early baby steps.
Yeah, I would just say, I think it doesn't change the fundamentals of Bitcoin, but basically, I mean, what is coming, every asset will be tokenized. So I think it's going to make using blockchain, it's going to be a daily use case. Everyone is going to be trading blockchain assets because that's going to represent your normal shares of everything, every stock that we buy. So
sort of a follow-up question to that. Do you think in the future AI would prefer using Bitcoin as a payment mechanism versus other types of crypto or fiat tokenized blockchains?
I think AI already prefers Bitcoin. I haven't seen an AI that doesn't choose Bitcoin as the best monetary asset.
I mean, I think it's obvious you need a natively or blockchain native electronic payment. And Bitcoin is actually native, whereas a USDC is kind of, there's a bunch of custody and whatever else. But to be practical, you need to, there's the whole issue, like every time you spend your own Bitcoin, it's a taxable event. So we may need maybe some exemption, maybe a de minimis amount where, there's talked about $600 per year or something. So you'll need some changes in the tax code as well.
I mean, is AI taxable? I guess this gets into theoretical questions, like what if they're independent? I don't know. But
Next panel.